Today, I sat down with Brian Harwitt, one of the partners at CoVenture, a venture capital firm who are investing in many things inside of the ecosystem that is e-commerce, namely aggregators. We had a conversation about aggregators and what a 10,000 foot view looks like, given that he has unique access, sitting on and listening to many of these founders talk about their businesses and their strategies. Like always, I hope you enjoy this one. For me, it was really cool to get to peer into the lens of what it looks like inside of an aggregator. Welcome to Successful Scales, the show where I talk to world-class professionals on what it takes to scale successful businesses. I dive deep asking questions to people who are running unicorn businesses, to raising funds, to buying businesses, mergers and acquisitions, IP and patent law, what is to manage performance management. I mean, the list goes on. The idea really is, how do I create knowledge and learning for you guys listening in? And of course, myself, getting the floor with people who I, in many cases, would never dream to share a room with. Before we jump into the episode, I've got to give a special thank you to our sponsors. Firstly, over at Global Wide Advisors, a leading digital consumer products investment bank focused on optimizing the sales process. An incredible team, always happy to pick up the phone and educate you or anyone about the sales process and what you should really consider, and can obviously help take you to market or even acquire businesses. I ring them for just about everything these days. Us over at Multiply Me, we are the end-to-end executive search and HR function into the Philippines, helping find better talent and onboarding them effectively. And last but not least, Escala, our management consultancy focused on process improvement, where we help build better systems for your business. That's all the ads you're going to get from me, ladies and gentlemen. The rest is all about learning. I hope you really enjoy and get as much out of these sessions as I do, sitting face to face with some of the world-renowned leaders in their respective fields, asking them the tough questions that they're not often asked. Brian, welcome to an episode of Successful Scales. It's an absolute honor to have you here today, mate. How are you doing?
I'm doing great. Thanks for having me.
Yeah, mate. I've been really excited about this. And, I sort of made it known when we were sitting together in New York a couple of weeks ago that to get your perspective and your insight into so many budding and existing entrepreneurs who are growing businesses really well, it's just going to give a whole different layer. And, before we jump into all of that, I'd love it for me not to butcher your background and for you to actually tell the listeners who you are, and, obviously a little bit about CoVenture would be fantastic.
Yeah. Thanks again for having me on. So, Brian Harwitt, I'm a partner here at CoVenture. I've been working here for about a little over 5 years. Before that, I was doing investment banking at an investment bank called Guggenheim. And like many of the people at CoVenture, I went to Cornell. And originally from LA. Now for CoVenture, we are a asset management firm that we like to think of as sort of the intersection of finance and technology. So we have a venture capital business called Crossbeam that's invested in a handful of these Amazon third-party seller rollups. And then we have, CoVenture, which has our private credit arm, which is where I sit. And so we're providing credit facilities to specialty finance, like fintech type of businesses, as well as companies that are rolling up or acquiring other sorts of businesses. So the Amazon third-party seller thesis fits squarely in there. It's like, where are you finding businesses that are built on new age technologies, new age platforms that do not have access to traditional financial services because they don't fully recognize these as small businesses the way they do pizzerias and corner stores and things along those lines. So that's where we really thrive, and why we really got excited about this Amazon third-party seller thesis.
Mate, very, very modest and very quick background into all that you do. I'm totally going to take the opportunity to start digging in deeper.
Perfect. Let's do it.
So I mean, just back to CoVenture for a second. You said that you came from a finance background. You were working in investment banking, and you said a lot of guys work from Cornell. How did it all come to be, and how significant was the Cornell Connect? How significant was that, or did that play into you guys all coming together?
Yeah, so it was for Ali and I, it was everything. So Ali's the founder and managing partner of CoVenture. He and I met when I was a sophomore in college at Cornell. I was going out for a business organization called DSP that we were part of. And he and I quickly hit it off. I just spent a summer in China firm. And he thought that was really interesting. And so we started chatting, and pretty soon after, he was starting CoVenture, getting it off the ground after doing some other tech focused work in his first couple of years at Cornell. And as he was getting it launched, he said, "Hey, I want to bring someone on as an intern, someone who can help do free work, essentially." And so I raised my hand, and for about 2.5 years in college, I was providing Ollie with all sorts of free work, whether it was like market research reports that we were publishing and giving to other VCs, helping on portfolio support, deal sourcing, sort of you name it. And so for about 2.5 years, I was doing that. Decided I wanted to get sort of the hard skill set in investment banking, and then 6 or 8 months into my job in investment banking, Ollie called me up and he's like, "Hey, I'm getting this credit fund rolling, and there's no one else I'd want to hire than you." So, decided that I wanted to hitch my wagon to Ollie, because he's incredibly hardworking, incredibly smart, and it was going to be knew it would be an awesome ride to work alongside of him, and definitely still feel great about that decision today. He's been a great mentor and person to work with.
Unreal. So, I always like to ask that question, because I think so much of everything that you achieve it's always about the people, right? I mean, we can talk about scaling businesses and we can go on and on about that, but at the end of the day, there's a human interaction and connection. And so it's always very interesting to see how people got their start and how, they've sort of come together. I don't know if I ever told you, but Lippy and I, we actually met playing Australian rules football. Oh, we did tell you the story.
Yeah.
Yes.
You explained to me what it was, and I was like, "This is an amazing sport, and why is it not here?"
Yeah. It is really an amazing sport, and it's a shame, because I just think about the American athletes. It would just be on a different level. But super interesting. So you jumped over a few things, and just so that everyone listening at home is on board or understand. So I'd love to hear. Firstly, you touched on a little bit around how it's hard for businesses that aren't brick and mortar to actually, find financial aid or ways in which they can actually lend money. So love you to sort of talk a little bit about what that is for people who don't have that visibility. And also, like, what was the thesis coming in?
Yeah, I mean, this is something that we've been observing across many different ecosystems prior to just being on the Amazon ecosystem. So for the first exposure to this was Uber drivers. So there used to be a timing mismatch in which you would earn your rides and then which you get paid by Uber. And so you had your gas bills, your toll roads, all of these things that were adding up, but you were having 14-day payment cycles. And so there was a company called Clearco that started factoring these Uber receivables. And we started paying attention. We said, all right, this is really interesting, because no one's providing or viewing Uber drivers as small businesses when in fact they are small businesses. And the extension then went to Airbnb hosts, and those became sort of small business owners in themselves, as well as e-commerce merchants. So this extension along those lines of how do you provide financial services to businesses that are built off tech platforms? And I think those were new things that banks and traditional financial services didn't really have a grasp around. And so fintech and specialty finance businesses came in to actually provide that infrastructure and support. So that was sort of where we began in the thesis. And then after that, we saw the same thing happening in the creator economy. So whether it was digital music streamers sort of on Spotify or any of these other platforms, and that's through a company called STEM that we work with, as well as on the YouTube platform. Many YouTubers are making millions, 7-8 figures a year on YouTube, but can't get access to traditional financial services. And so they're not being able to grow their businesses and relying on just cash flow to reinvest in their businesses. And so finding companies that are providing financial services to those creators as well, who are, in some senses, much better credit risks and much more profitable than traditional small businesses. And so then, after that, it became Amazon third-party sellers. And so we had spent some time actually in probably 2017 looking in that ecosystem through a couple different lenses, mostly through the lens of how do you provide financing more so than acquisition to these third-party sellers. And a lot of it was speeding up the AR cycle from Amazon to these sellers so they could convert their working capital. And then as the time went on, we saw, all right, well, there's amassing more and more of these businesses. And there became a really interesting opportunity to acquire them, roll them up. And we saw that initially with Thrasio. And then obviously, as many of these other companies came along, we started to get more and more excited that it wasn't just one player, that there were many players. And we began to appreciate how really large this market was, where it wasn't just going to be one winner, that there could be, $5, $10, $20 billion businesses built on the back of this ecosystem.
Yeah, super fascinating. And I think what I really like about sort of the thesis or sort of the viewpoint is that you studied other markets that experienced these trends early on, and you've replicated the model in something now that, is really proving out to be. I mean, we talk about Thrasio, 3.4 billion raise, and that's the first mover. They definitely get the first mover advantage, but there are some other very serious players and serious players that you guys back as well.
Absolutely.
That there's a lot of opportunity that's happening here. So, just to sort of set the stage here a little further. So you guys are investing in the aggregators or a bunch of aggregators, as well as, Clearco, Clearbank, and, everything that is helping finance, a lot of these incredible entrepreneurs who've had and built great businesses and great brands that exist inside of this 3P third party seller platform marketplace that is Amazon, and beyond now. And I think, I'll save it for the end. I want to hear some of your predictions on sort of the shift in the market over the coming years. I've got a few of my own, but in taking all of that, I mean, how many, I don't know if you can disclose, I feel like you probably could, but how many aggregators have you backed to date?
Yeah. So on the credit side of the business where I sit, it's 5. And then on the equity side of the business, there's a handful more that cover geographies that on the credit side, we don't work in yet.
So I guess the real point there is that it's not one, it's multiple. And, we're talking about plus minus 100 aggregators. So we're looking at, I think, about 5 to 10% here. You're touching them in some way, shape, or form, which is, no small feat here. That shows a whole lot of confidence in it. And so just to take one step back and, for anyone who hasn't been paying attention in the space here, there's been accounted for north of, you can look at marketplace pulse acquirers. I think it's north of 12 billion now has been invested in venture and debt. And the objective really is, how do we acquire as many of these businesses, these 3P seller businesses, and roll them up into something that, financially makes sense. And it's, not to discredit it in terms of what they're doing, but it's like a bit of financial arbitrage. If I really boil it down simply, is how do I acquire these businesses, and then how do I operate them at scale? Which, I'm talking it down a little bit as to what it is, but it's a very complex and challenging thing to achieve. It's one thing to theorize what that is, and it's a very different thing to actually pull it off. So as one of the guys actually sitting there on the table, having people effectively pitch them on why their aggregator and why their business is going to be one of the 5, 10, 15, 20 of the potential 100 plus that exist in market today. Like, what are you guys looking for? What are you reviewing? What are you asking from them? Like, what does a good investment look like in your eyes?
Yeah, it's really interesting. And I think one of our portfolio companies had sort of put this in my brain, and it stuck with me, is that you're looking for, a core team. And this is how we thought about it, which was, you need someone with Amazon expertise and operational capacity. So they have to know the front end of Amazon. They have to know, keyword searches, optimizing the A+ content, and everything that goes on the front of the page. I think that's a really important skill set. And then there's also, you need the person who can get the product to Amazon or to the 3PL provider. And that's your supply chain person. And they can go source the products in China or wherever they're getting in those geographies. They have relationships with brokers. They have relationships with manufacturers. They have people on the ground who can, do QA on the products before it comes to the US, when it's easier to rectify any issues and to avoid any issues from Amazon dinging you for poor quality of product. So that's sort of the second prong of it. And the third prong is someone who can actually execute on the sort of the M&A activity, do the financial due diligence, make sure there are no holes in the businesses that you're actually going out and acquiring. So that's that 3 prong. And underneath, you can have other people like brand managers and head of people, and making sure that everything else is run smoothly. But it feels, those 3 are important. And the thing that one of our portfolio founders said to us that really resonated was, it's not an addition equation, it's a multiplication equation. So if any of those are a 0, your business is a 0, because if you can't get the product to the US, you can't get the product. It doesn't matter how good you are at selling it. you don't have a product there. And the same thing is if you have a great product, but you don't know how to sell it, it's worth nothing. And then if you have someone who can't actually execute upon the M&A strategy and you're missing key things in due diligence, then the business is going to really struggle. And so those are the things that we're fundamentally looking for. And to find each of those, how do we test, who is a good Amazon operator? So that first prong approach, we often ask for the battle scars. And, we talked about this when we were at lunch, is like, what are the stories you can tell me about how Amazon took down your listings, how someone hijacked your page, how someone, put keywords on the back end that made it sound like you were selling amphetamines or adult products or things along those lines that push you out of the main Amazon search. And so I want to know how you resolve those things, because when I'm in the battle, sort of on the battlefront with you, I want to know that you can resolve that quickly if those issues were to come up, and how to look out for them and prevent against them. And so that's one thing that I always like to ask. And then another thing within that is sort of straddling between 1 and 3 is when you're looking at new businesses, what are the black hat tactics you're looking to identify to make sure when you're acquiring one of these businesses that you're not coming into a business that has a massive liability associated with it, or that is not going to immediately get delisted or deranked because it turns out you were buying reviews or things along those lines. And so we're trying to always make sure that you're protecting your business, whether it's once you're operating assets or when you're acquiring the assets. And that, I think, anyone would say that requires a lot of scar tissue and operating experience within the Amazon space to perfect that.
Amen. I mean, it's like I told you at lunch when you were telling me that how brilliant it is. And it's really one of those things where, like, if you know, you know. And if you've had those moments in time where, you've been kicked out of Amazon, you received those very frightening. I mean, the phone call is like the most terrifying, which I've experienced. But the messages of stop this activity, etc. I told you a little bit about my backstory, and one of the original founders was not the most white hat of characters. But anyway, I think that
those things evolve over time, right? Like, you can't be only focused on what the black hat tactics were in 2017. Because they change every year and people get smarter and Amazon evolves and these sellers evolve. So it really is amazing, the creativity and ingenuity that people come up with to win in this platform.
And that's the real beauty of the entrepreneurs driving a lot of these businesses and coming up with the ideas and building the brands to a position where they can no longer really scale it, whether it's a capital problem, which you guys are addressing, or an operational problem, or
right.
There's, a million things, like, it's compounding complexity as you grow the business. I think one of the things I really find interesting, or I think one of the key differences that I want to call out, and I think what's so cool about what it is you get to actually do day in, day out, is that unlike the companies that you financially back, you're looking at the actual founders and the core team, and your decision rests heavily on the people, whereas their decision and sort of where the market sits today is very much on the product and the brand. It's the acquisition of the asset, not the people. And, I'm trying to think off the top of my head. I would say backing the people is much more challenging than it would be backing the actual product, because if you understand Amazon, if you understand the strategy, if you understand the aspects around supply chain and the acquisition tactics, etc. You're acquiring the assets, and if you can integrate them into the business, then you're going to be successful. But you need a degree in psychology there as well.
Yeah. Oh, it's really fun. We feel very fortunate that the flood of entrepreneurs that came into the space. And sometimes when there are these hot markets, there's a lot of opportunists that come in who might not necessarily have the best background to be the most sophisticated. In this instance, we kept running into people like, oh my God, these entrepreneurs are unbelievable. They are really top tier, high caliber individuals. And so it's been super fun to get to know them and to build relationships with these people who are, really, really impressive. And one of the groups we just, announced with is a group, to a 23 and 24-year-old, and they built a business from college, and they've scaled this business. And, we've had other folks that are not much older and that are building even bigger businesses or same size businesses. And it's really fun to see the quality of talent that has come into the space. And so we spent a lot of time with each of these management teams prior to making investments and went through this really rigorous process of multi-weeks up front and then confirmatory due diligence after signing a term sheet, and then post just monitoring the day-to-day performance. We have Seller Central logins and are looking at sales on a daily basis. And so there are a lot of things that we have access to and updates that we get to see and dialogue with the company that I think is really unique from the position that we get to be in.
Yeah, super unique, super valuable, and just a ton of insights there. So just to dig a little deeper there, like once you invest in these businesses and you've backed that as a potential winning horse, what does the ongoing relationship look like? Is it just we're handing you over the funds, we're making sure that things are going to plan? Are you a little bit more involved in it? Are you actually getting eyes in perpetuity? Like, are you going to log into Seller Central on a semi-annual, semi-regular basis? Like, what does that actually look like?
Yeah. So the really unique thing about being a lender versus being an equity investor is you are much more involved in these businesses on a daily basis. The company is either growing past the current size of the facility, they need flexibility on certain covenants. The market is changing fundamentally, and you have to rethink certain elements of how the loan is actually operating. You have to monitor the performance because in equity, you can lose money just based off of the return profile. In debt, you can't. So you're mitigating for downside risk. And so the relationships we have with our founders is some of them, we're talking to them, most of them every other week on a call, getting updates on brand performance, pipeline of acquisitions, things along those lines. We're also on a monthly basis logging into Seller Central. So that's every month and corroborating top line reporting from our underlying borrowers and making sure that ties to Seller Central. And that's one of the themes that we really like about this thesis is like in traditional small business roll-ups, you're sort of relying on self-reported financials, and it's easier for there to be some, accounting nuances that are going into this that make it harder to understand how the actual performance is. In this, you can go and see exactly what top line revenues are within a few percentage points because there are some reconciliations that happen there. And then you can see exactly what the Amazon expenses are. You can see what the advertising expenses are. And you can pretty easily see what the landed cost of goods sold is by doing a reconciliation of the invoices that you have from the companies. So that's a really interesting thing that we can do. And we're obsessive about it. Like, we want to make sure that we stay on top and understand the performance of everything that's going on within our portfolio companies. In addition to that sort of like in-depth monitoring that we're doing, we're also sitting as board observers on most of these companies so we can hear the board level discussions that are happening. We're approving deals that are going outside of concentration limits or outside of eligibility criteria. We're doing, we're pretty active, I would say, talking to most companies multiple times a week, if not every single day. So it's a really active relationship and allows us to see a lot of what's going on in the market in real time.
Unreal. I just wonder, how many hours do you work? Because you guys aren't a huge team, right?
We have, I feel very, very lucky. We have a really great group of people that work super hard and gets along really well and is working towards a common goal of just growing this this fund. So it's been really awesome. And so, we have a couple people on our team who are mostly focused on the Amazon thesis, and they're the ones who are really driving the ball forward here. And then we also work with third party service providers like the Centuricas of the world to help us in areas in which we have less operational capacity to free up some of the bandwidth, like for auditing invoices, POs. That's something that we probably won't do, but we'll hire a third party to help us work on that with.
Yeah, that sounds like a much smarter investment than you looking through someone's invoices and POs. Totally. So you guys have really been, you've been at CoVenture 5 years now. You guys have backed in a number of these aggregators, and you have really built a thesis on the industry and its trajectory and where it's heading, so much so that you actually have sway and influence into sort of where it goes, which is a pretty cool thing to have influence in when so many people's lives are impacted by it. And, by you guys actually jumping in, it creates a whole lot of opportunity, which to me sounds like that was the whole initial thesis. So what do you foresee over the next 12, 18, 24 months? Like, are we going to see more aggregators diving into the space because the market's ripe? Are we going to see, what's the end game for a lot of these aggregators? I'm going to let you talk to this because I could start throwing out my ideas, but yours are going to be better.
I don't have a crystal ball or anything, but what I'm seeing is I think the continued professionalization of Amazon as a platform. And I think that's an actual thing that happens as you have more and more sophisticated aggregators rolling up these different businesses. And so you're just going to see this become highly professional in the same way Airbnb did. So, I mean, probably 5 years ago, when you go stay in an Airbnb, it'd be someone with an extra room and you could go stay there. And it was sort of like a little bit of an odd process. And now you feel like you're going to a hotel. If you're staying in an Airbnb, you have a property manager, everything's clean, they have a welcome gift. It's really nice. And so I think the way the Amazon ecosystem is, it's going to professionalize in the same manner, and there's no choice because it's going to get more and more competitive. And these aggregators have resources and abilities to deploy strategies that, and more importantly, working capital that mom and pop operators don't necessarily have access to. And so I think that's sort of the primary thing that we'll see. And from that, it's going to be ideally a better shopping experience for consumers because you're going to have better products, more consistency, better customer service, things along those lines. And ultimately, I believe that will translate to further growth in sales within the third-party seller ecosystem and platform itself. COVID had a really interesting impact on e-commerce where it pulled forward I don't know how many years of sales in behavior. And I think there was a little bit of softness coming out of COVID as people started going out and shopping more. I think that's the one thing that we'll be curious to track is like, where does consumer demand go from here? Is it going to continue up and slowly get back to the peaks of the COVID bump, like people would say in sort of March and April of last year? Or is it going to plateau here for a bit? And so that's one thing that I'm less certain about. But there's so much.
What's your take on that? I mean, I'm just listening to you talk about it. And I know it's something that we all talk about, Q2 and 3, fairly sloughed in this space, but you could hypothesize that, right, we were all cooped up at home. We had nothing to do. We spent a whole lot more money online. I mean, I didn't. I live in Israel, so I'm lucky if anything actually gets here. But if I was still living in the US, I'd probably be in like minus $1 million right now. But I find it very hard to believe that we live in a reality where when consumers who are not exposed to an online retail experience long-term will not take that convenience over the desire to go and be inside of brick and mortar, maybe specific verticals or, let's say shopping for clothes, which actually, especially in the US, the return policies and the simplicity of it all is there that you don't really need to worry. But I just find it hard to believe that, this softness that we've experienced is not just a true reflection on the emotional tax of being inside for so many months on end.
I think you're probably right in that it's a temporary softness. And I agree with you. I think Amazon is a tremendous resource. And I think there was a couple things that came from it. I think there was probably a big push to support local businesses that were struggling during the pandemic. And I think that probably drove some traffic there. I think there was a big push to try to regain some sort of normalcy, and going to shopping malls was, I think, in a weird way, a nostalgic way of returning to normalcy for a lot of people is going back and being in person. And so those were probably some motivating forces. I think that the messaging, I think Amazon has had a hard time controlling the messaging on the business as a whole. And one thing that they need to really focus on is they are empowering small businesses. They are Amazon third-party sellers that are making millions of dollars a year off of Amazon's platform, right? And so I think that there's a lot of negative publicity said, buy local, not Bezos. And I think a lot of that is very fair and warranted. But I think Amazon needs to do a better job communicating that we're actually empowering a lot of small businesses along the way. And so I think like they can get that messaging, and I'm hoping that drives more, because there's the macro level demand from an e-commerce perspective, and then there's sort of the consumers who are saying, all right, do I want to buy from Amazon or do I want to buy from my local person, and some of the impacts and associations with that.
Yeah, I would tend to agree with all the points that you've just put out there as well. So I want to go back to sort of your day-to-day, or what you guys are seeing, really, because for me, on a personal level, it's super interesting, right? I honestly think you guys have one of the most interesting jobs because the deal flow that you see is you really get to see business ideas and incredible entrepreneurs and existing business owners coming with how do we really take this to the next level and the next level and really blow it out of the park. So, I mean, I know one of the things when you talk about, credit, and debt providers, and when you talk about venture capital, deal flow, it can be overwhelming for some, probably most. So I'm curious, like, what does that process look like for you guys? Like, how does someone get on your radar? How do they get your attention? What is an interesting acquisition target for you guys?
Yeah, it can definitely be overwhelming. And the best way to get to us is through warm intro. So if someone knows us, who we like and we trust, and that person, you can see, and then they can connect us, right? I think that's the easiest way because then it's vetted through a source. If you're coming in through my email and I've never met you before, it's harder for me to verify that it's a real opportunity, and we're already taking 40 meetings a week, and it's hard to sort of carve out the time for something that the value is unclear. Also getting people reaching out on LinkedIn, which is a good channel because you can sort of vet the legitimacy through their LinkedIn profile and see whether or not it's something that's worth our time. But now we have 5 people on our investment team on the debt side, adding a 6th and hopefully a 7th soon. And so we sort of split up the responsibilities, and in some cases by region, in some cases by stage, who on the team takes that first call, and then move the ball sort of through the process at that point in time. But a lot of it is, going to come down to, how high fidelity the source is that it's coming through, the stage, the operator, and all those sort of factor in there.
Yeah. And like when you look through the vetting process, so, someone's come in, they've had their first call, they've been warm intro, they're going through that process. Like, do you guys have a very stringent criteria? Like it has to, I understand, right? Like when it comes from an operator perspective, for the Amazon thesis, like, okay, have to have someone who understands supply chain, has to have someone who is an M&A background, and someone who has the true Amazon battle scars and have been through it. But, are you guys, I always look at like, how do I scale this? Like, how do I turn the 40 opportunities that you see a week into 400 opportunities, and how do I automate that whole thing? So I'm just curious, like, what does that next layer look like for you guys?
Yeah, no, it's really interesting because, we spent a lot of time looking and analyzing, like, where's our deal flow coming from? And we do some reports on like, where is our total deal flow coming from? And then where's the deal flow that actually became actionable, that was term sheets or closed transactions? And it turns out that most of them come from venture capitalists. And so we spend a lot of time building relationships with VCs. I think we're in a unique position because we can be the voice that tells them about what that capital markets is going to provide on these companies. And so it's a really unique place to be, where you can provide equity and debt. And so right now, that's the highest fidelity source of deals. Some other sources have some interesting things. Actually, entrepreneurs that we also back, or other entrepreneurs in the ecosystem, are also very high fidelity sources. And so it's like, how do you double down and continue to build relationships in those ecosystems, because those have proven out to be the highest ROI sources for deals.
Yeah, and that makes a lot of sense. Coming back to the original discussion point of like business and investing in people versus acquiring a product or a brand. At the end of the day, it's always going to be about the people. And so understanding who you can trust and how they operate together is such a fundamental thing. And I think something that you can never take away, that human component of what it is. It's not just, numbers on a spreadsheet that's crunched, to spit out an EBITDA that looks attractive or doesn't, right? There's a whole lot of additional factors that exist. So coming back to it, what sort of advice would you give to people who are looking to find themselves in a position to be a potential target for you? Or, I would say what's probably going to be most interesting for the listeners as well. And I'm certain you have a pretty good insight in terms of, what brands make sense for the portfolios that you invest in, and what are the things that they can do to really make them an attractive offering to do something, either way, life-changing.
Yeah, I'll start with that one. And I think there's definitely a lot of interesting things. And a lot of it comes down to we're providing the capital to the aggregators and we have a say of what they can and can't purchase, right? And so a main thing that we're focusing on is evergreen. We don't want anyone buying trendy or fatty things that are electronics that could go away or could be irrelevant. And so focusing on evergreen sources of products that will be around forever, because we want to look at these as annuity streams. We don't want to look at these as sort of like fuses that go out over a couple of years. And so that's one thing, is like build products in categories that are durable. I think that's really important, and build genuinely differentiated products that can't be competed away by your next competitor, either ramping up their PPC spend or lowering their price, or some combination of the two. Like, how can you build real durable moats? Some of that's through the ratings and review moats, but things along those lines. The second thing in relating to that is like, don't become overly reliant on PPC spend. Because like, if you take your foot off the pedal, then all of a sudden your top line is gonna sink, and that makes it harder for people to want to invest in the business, even if your EBITDA margin is improving as you lower your PPC spend. I think that if you become overly reliant on PPC and you drive revenues up and then it comes back down, it can be negative signal for some folks. Another thing that we've seen as a struggle at the finish line as you're getting your business acquired is who's responsible for buying that next inventory purchase. I think something that we've seen across aggregators, especially with the supply chain crunch, is you buy a business, you say, oh, it's only going to take me, a month and a half, 2 months to get stock in for my next order. Then it ends up taking 3-4 months. And so you're stocked out for a month or two. And so how do you work with the aggregator to make sure they feel comfortable with your inventory supply plan, whether it's what's at your 3PL or Amazon, things along those lines. So I'd say those are some really some good ones, a couple things to keep in mind as sort of you're growing your businesses.
Yeah, great insights. And, I speak to a lot of the, M&A guys inside of a ton of aggregators. And like, that's one of the big challenging points is like, okay, we're under LOI. We've got 30 days. And it's like, well, I don't really want to ramp my ad spend, and I don't really want to reinvest all this money into, bringing more product over. Like, it's their problem now. But in reality, and this is why stability payments, effectively came into play, is like how to aggregators protect their interests and, align the interests effectively of the seller as well. And so,
and when you have to report to your lender, like when we're seeing the reporting packages that come in as the LOIs are executed, and if we see a downward trajectory, we're like, what's going on here? Like, is there some underlying reason that this business is struggling, or, is it just a PPC pullback? Is it stock outs? And so we're always trying to find the root cause of it. And is it something that is terminal to the business, or is it something that's temporary? And so I think those are the things that we're trying to sort out. And so the better job that they can do on that front will make it easier for them to sort of smoothly go through the process with the aggregators.
Yeah, I mean, absolutely. Well, on that point, like, what are some of the mistakes, or let's say like I would say almost like short-sighted mistakes that sellers, like brands, make, thinking like, I'm going to squeeze that little bit out, or I'm going to, like, what are some of the big mistakes that bite sellers, sellers of brands who are selling to aggregators, comes to bite them in the ass?
Yeah, I would say hiding things. Don't hide things, because most of these people that you're selling to are very experienced in understanding the tips and tricks of Amazon. So if you are using a PayPal account to buy reviews, or reimbursing people for product, giving out gift cards, things along those lines, and you're not disclosing that, you're going to get caught. And when you get caught and haven't disclosed it, the aggregators or whoever's buying the entity is going to think that you're doing this elsewhere in your business. And so it's sort of where there's smoke, there's fire. And I would say just make sure you're disclosing what you're doing. A lot of people's like not paying their duties, and sort of the tariffs and taxes associated, like pay those, make sure that those are being resolved, because that creates a headache at the 1 yard line, and complication as it relates to that. I think those are the main things I would think about. Is just like being, be open kimono with it, be full disclosure, because you don't want to be in a situation in which you're getting close to the finish line. You think you have a deal here. This is your deal. and you're one-to-one, whereas this aggregator might be buying 5 deals at a time. And you don't want to be in a situation where something that they found out later on in the process, once you've already feel like you have that money in your pocket, is taken away from you because you didn't disclose something that was material to them. So that's what I'd say is my biggest advice.
Yeah, great advice. And I think I heard, I think Stephanie Lee she's the COO over at Thras, on a Clubhouse back when that was in vogue, and she was talking about like, just tell us if you guys are buying reviews. Literally, just tell us,
right.
Because it's, you're going to inherit that, and at the end of the day, and if you've been through this process, you never forget it. It's harrowing, to put to have to submit your POA, your effectively the actions that you're going to take to resolve anything that might have gone wrong. And for anyone listening as well, and anyone selling on Amazon, like there's been some pretty heavy changes to the the TOS right now in how you actually sell on Amazon. Everything that relates to review manipulation and rank manipulation, like tech platforms have been kicked off of the actual ecosystem, which is the first that I've heard of this magnitude, and like in the community that I'm aware of. So yeah, I mean, again, just great advice.
Yeah. I mean, you got to be careful because they've made examples of a lot of sellers that are sort of based out of China. I mean, we saw that huge quantities of sellers that were large sellers taken down for TOS violations. And I think they'll continue to make examples of people who do not follow TOS or blatantly violating and have multiple violations. So I think that's something that just sort of across the board. In one other point that I think is worth bringing up that I failed to mention early on about like sort of where the crystal ball moment is, I think that the aggregators will continue to have to differentiate themselves in ways that is not just financial engineering like we were talking about at the beginning. And so that's going to be either developing or buying software or tools that actually enable them to analyze businesses better, grow businesses better, improve their return on ad spend, things along those lines. And so I think that also goes into the compliance piece of it, is like, how are you making sure that you're staying on top of Amazon terms of service? And how are you making sure that when you're buying businesses that there's not all sorts of fake reviews? I mean, what was it? Review Meta was just bought by, I think, one of the aggregators, and other tools along those lines, I imagine will find their way into their hands.
Yeah, absolutely. I think as well, while we're peering into crystal balls here, I think one of the interesting things that I believe will come to pass is that the focus to date has been very much on the acquisition side. How do we buy these brands? How do we operate them? And then how do we grow them, whether it's through additional marketplaces or countries or D2C or any way in which we can grow those businesses. But I think, like, as we see the evolution of the industry, P&G, they invest extensive amounts of money into product development. And so, the second coming, if you will definitely be, in my opinion, on how do we actually operate at scale, which is what everyone's trying to figure out right now. But then once we do that, it's not going to be enough to just have a product that lives in market for the next 10 years. I mean, you can build something super evergreen, but there has to be a degree of innovation. Apple isn't the brand it is, and a lot of great brands, because they had one product that sat there, or a suite of products. Every year, like clockwork, there's an upgrade to the iPhone, to the iMac, to the MacBook, to the entire product suite. So
absolutely,
I'm interested to see what that looks like.
I mean, you're starting to see it. The low hanging fruit there is just more variations, colors, sizes, packs of different things. I think that's sort of the low hanging fruit. And then the next lowest hanging fruit is, people are complaining about my product. Let's fix the tweaks. How do we make it such that, our sizes are more, fit to norm? And then beyond that, it's, all right, well, I own a business that sells knee braces. How do I make ankle braces? Or how do I make things for people with tendonitis, or things along those lines, where you can actually build off of the brand that you have in a way that Amazon, you haven't historically really thought about branding, besides just having nice pictures and A+ content. So it's going to be really interesting to see. And I think the biggest thing that has held that back historically is access to working capital, and access, because right now, I think we talked about this before at lunch, like you are putting 6 to 9 months of inventory on a ship to get here. You don't have a lot of extra money to, come up with new ideas for products or invest in new products. You're just trying to stay in stock. And so I think as the supply chain is right sized, I think as everything has gotten a little cleaner, that's going to be the other place where I think people will have more time and opportunity to explore that.
Yeah, I think that's going to be interesting. So at what point do you see that, traditional institutional capital and banks are actually going to say, okay, we no longer need to worry that there's a physical brick and mortar store. Like, this isn't going anywhere. Like, when are they going to really start to come to the party? Do you think that'll happen ever?
Yeah, I think it will. They'll toe in certain ways. I think that for Thrasio was an obvious way, for JP Morgan, and I think there was a couple other banks involved in that syndicated debt. That was more so from like a enterprise value, at least that was my perception of it, or like venture debt type of loan. And they had $1 billion plus of equity in the business. And so you're looking at it more from the lens of like the capital structure looks like a traditional growth equity, private equity owned company. And so I think there are ways that they're participating. I imagine they'll be participating in other ways in working capital. I've seen them in small sizes, providing AR lines and borrowing-based facilities to these businesses, but nothing of substantial yet or relating to the cash flow of the businesses. I think that we're still a little ways away from seeing meaningful participation beyond small loans for working capital. But I think that we're seeing larger funds move in. I think there were 3 of us that were doing it out of the gate, that have all been sort of in this tech-enabled world before. And now we're starting to see really large financial institutions, the BlackRocks, Blackstones, Apollos of the world that have been in the asset, alternatives business for a long time, starting to participate. And so I think that's sort of the next wave. And then once that's gone, I think you'll start to see the banks coming in, because they'll see this has a bit more data, 5 years of operating experience and hundreds of millions or billions of dollars of opportunity in front of them. I don't think they can ignore it for much longer.
Yeah, I mean, I can't wait to have you on again, Brian, firstly, because I just think that like when we have a conversation, let's say a year from now on the same topics, like that's another year of data that we have. In reality, Thras raised its first bit of capital probably 3.5 years ago, maybe 4 would be my guess. You would probably know.
Yeah. Fortunately, yeah. Because we had to pass on it a few times, but yes, something like that.
Well, I didn't want to rub that one in, and
okay.
but realistically, it's not that long. Like, when you think about traditional businesses, no one's really making acquisitions on businesses that have had at least 3 years in operation, because you want to understand that it's not really a business that had its moment. Like, there was some significant moment, it grew, and then it was sort of. My dad, he's saying always comes into my head, but it's a terrible saying. He calls them like fly-by-nighters, where they sort of, they went up and then all of a sudden it just sort of crumbles. So we're still so early. It's still such a nascent space. And so it's just exciting. It's exciting to hear from your lens what it looks like right now. And yeah, I mean, I'd love to have you on again a year on and see where it sits.
We'll see whose crystal ball is more accurate at that point in time. We'll see what comes true.
My crystal ball, I think, is probably years out. And honestly, we had a bit of a conversation, but that's one of the things that I'm actually backing in heavily, is that there's not, when you take the founder out of the business, they are the engine room to build new product. And so while you can run and manage and make slight differentiations around the product, until you build or recreate that engine room, then you're losing a key function in the business to drive that forward. So I mean, we talked a little bit about it. I'm not going to go into too much detail here, but the thesis is, if we can build assets that are more attractive and create more time for potential aggregators to work with them, so that they can figure it out in their own time, as opposed to like, holy shit, we've just acquired an asset and we're plumb out of ideas here. What do? We have to go and build these departments. Then, that's going to buy them time, and time is a critical function here. But anyway, I digress, mate. I digress. Brian, It was an absolute pleasure having you. Thanks again. I know how busy your days are. I've loved every second of this. And mate, to the best of luck to all of the companies that you've invested in. I mean, I've met Ali. I've met a couple of guys on the team, and you guys are all wicked smart. So I'll be surprised. I'll be surprised if you're not backing lots of winning horses here. And I guess the beauty for you guys is not well. When it's debt, I guess it does have to be. It does have to be a winner, right?
Right.
But
right. But we've got Ollie's got his equity stuff as well, so we're covering all of our bases here.
No surprise to me right there. But again, thanks for coming on, and mate, it was a pleasure.
Likewise. Thanks so much for having me on. A lot of fun.